Despite all the recent doom and gloom, multifamily asking rent growth recorded its second best year this century, with a 6.2 year over year growth nationally. And even better here in Central Florida, with Orlando leading the way with an 8% year over year growth. We did finish the year downward due to, in large part, the Fed, who spent all of 2021 arguing that inflation was temporary and then saying precisely the opposite in 2022. In its quest to deflate inflation, we witnessed the Fed hike rates at the fastest pace since the 1980s. They increased rates 7 times in 2022, and 4 of those increases were 75 basis points. To put that into perspective, how outlandish that is, the last time the Federal Reserve hiked rates by 75 basis points was in 1994, and it did so only once that year. As a result, in multifamily, we're seeing deals come back to the market with lowered pricing to reflect current capital markets and future outlook. This means we may have opportunities on the horizon. Yes, if your value add plan was to refinance your bridge loan into long-term fixed debt and you underwrote the deal at a 5% mortgage interest rate, and keep in mind, we were in the low 4s early last year, the property may not cash flow as projected and long-term returns could be much lower. So do we expect that to continue this year? Will we see more of a buyer or seller market nationally? What about Central Florida? Let's find out next. Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. In this group, we learn from and help each other invest in multifamily with a focus on Greater Central Florida assets and/or potential investment partners. All right, so Dan, good to have you on, man. It's been great to get you guys back on. I know Carl did this last year. He actually did it for a couple of years, and it's always one of the best shows of the year because I think people are in that mindset. Okay, what happens next? And of course, last year we were kind of passing from COVID, and this year we've got some madness in the area. So it's always good to get a perspective outside of the folks we normally work with and do deals with to see what that kind of looks like from that third party perspective. So what I want to do before we kick off the bio on this is your bio and kick off with your presentation. So I just want to give folks a chance that this is their first time to kind of introduce themselves. I know sometimes people get a little shy and they don't want to say too much, but if you just want to say, your name, where from, and what you're looking to get out of the show, that'd be great. If you just want to say your name, say hello, I'm here, that's fine too. But and then of course we always have those that want to give a presentation. So please keep it to 30 seconds or so if you want to introduce yourself. So we'll just kind of take a pause there and let those folks that are new to the show here to kind of sound off. So I'll pause on my end. And then we got some new folks. If you don't want to say anything, that's fine. I'll pause for a few seconds and then we'll just keep rolling if you don't want to speak.
My name is Lariluz Gomez. From
Frankie Gomez.
Yeah, from Clermont, Florida. Just trying to learn something new.
Good to have you guys on, and it was great to be in Panama with you guys. It was a great time crossing the canal. And part of what this investing in real estate and doing it passively is to have an opportunity to be wherever the heck we want to be and still have that passive income. And that's why we do it, right? To be able to take those memorable vacations. It was really great to meet you guys. I had a great time.
Same, thank you.
Next time, I think what were we thinking? Germany?
Maybe,
that sounds good.
Maybe.
That sounds...
All right, good. Well, good to have you guys on.
Hello, everybody. Hello?
Yeah, we can hear you.
Hey, my name is Jonathan Bowers. Thanks for having me on tonight. I'm driving right now. Otherwise, I'd turn on my video. But I live in Newport Beach, California. Been out there for about 5 years now. My wife and I moved when she and I bought a chiropractic office for her 5 years ago. But I have businesses in Florida, in DeLand, Pensacola, Panama City, Fort Myers, and I primarily raise capital as well as syndicate storage and multifamily deals.
Great, Jonathan. Good to have you on all the way from California, man.
Yeah, I do a lot of traveling. Delta loves me, brother.
I got that. Well, awesome. Good to have you, man. All right, who else we got here? Anybody else want to sound?
Thanks.
Going once, going twice. Oh, here we go.
Can you hear me?
Yeah, we can hear you.
Yes, my name is Francis Lewis. I'm based in Delaware, actually. What I do is wholesaling, mostly on the commercial side real estate. So I have a few properties, like over 50 units I'm looking to wholesale. The title mentioned multifamily. Even though it's based in Florida, I thought like I probably could find a buyer or potential buyer here. So I'm just looking to connect and, learn something.
Good. And on that point, what we'll do is, if you haven't done it already, go ahead and use the chat and put your information on there so that people can get a hold of you if they're interested in learning more about you or what you have to offer. So good to have you on.
Thank you, sir. Sound good.
All right. I think that covers everybody. So let's go ahead and at this point, kick off the formal intro here for you and for Dan, our distinguished speaker, and then we'll turn it over to him. So again, please go ahead and put your information on the chat. And while you do so, I'll go ahead and turn and actually start the introduction with a formal bio. So Dan is a market analyst for RealPage Inc., where he focuses on conventional apartment market analysis, research, and data methodology. Dan leverages his background in REITs and institutional investor client services to allow for easier consumption and application of data insights and analysis. Prior to joining RealPage, Dan worked as a leasing consultant and an assistant property manager at a national apartment investment and management company. Dan is a native of Chicago and received his bachelor's degree in sociology from the University of Iowa. So Dan, I know you've been at this for a while. You gave me a great presentation that we're going to put out in front of everybody, and you've actually focused some of this, especially towards the tail end, on Central Florida, which I think is going to be great to get to both the national and then zoom in to the regional and even city level on some of these. So I'm excited. So with that right there, I'll go ahead and stop talking and turn it over to you, and you let us know how you want questions, Dan.
Fantastic. Whatever anyone is comfortable with, certainly can take questions during the presentation. If you don't want to forget it or don't want to write it down, can certainly do it after the presentation as well. I think there's about 45 or so slides. The first half is going to be a national, kind of that 30,000 foot overview. And then we'll dive in, I think it's about 7 or 8 different Central Florida markets. And we'll dive into those and we'll go from there.
Right. Sounds good. And if anybody wants to, and I guess for questions, if you don't want to sound off, just go ahead and put it in the chat and I'll make sure we ask on your behalf. So definitely want as many of these questions out there so we can get great answers.
All right. And I'm going to do the typical question. Can everyone see my screen? Take that as a yes. All right. So 2022, what a year 2022 was in the apartment market. Such a vast difference from what we saw not only in 2020 with COVID, but certainly in the recovery that we saw in 2021. And one of the main things in 2022 was the shockingly weak apartment absorption. And the weakest dating back to the Great Recession. And so we're going to review probably in the first 8 or 10 slides what caused the absorption, and then dispel some myths surrounding that, Already touched on a little bit in terms of consumer sentiment and kind of where everyone's minds are at, considering the Fed raising rates and kind of everything going on with the economy. So we'll dive into that. We'll get into rent and occupancy fundamentals. And then, like I said, I've got a couple of the Florida markets. The last market we added is Ocala. It's a very small market, so we don't forecast it. So I had to kind of switch a slide up a little bit, but when we get to that, we'll go through kind of some of the differences. So when we look at the apartment absorption, and this is going to be annual absorption or trailing 12, and what's great about doing presentations at this part of the year is, you know, everyone's used to looking at things from a calendar year basis. And so now this gives us the opportunity to look at calendar year 2022 and compare it, you know, going backwards. And we can see that on a trailing 12 or on an annual basis in 2022, we actually had negative apartment absorption. And this is the first time, like I said, towards the Great Recession. And a couple of things I want to point out is, you know, you see the bump in the absorption, you know, post the Great Financial Crisis, and then just this massive upswing in the demand in that late 2020 and into 21 time period, and then the fallout from that. And in the next couple of slides, I'll dive a little bit deeper into kind of why that is and how we got to where we got from an annual perspective. But you can kind of see just the scale of how the absorption and apartment demand kind of fell off in 2022. And so this slide shows a great, from going from fourth quarter 20, obviously through the fourth quarter 2022, and breaking down the absorption by quarter. And you can see that we were, you know, saw typical absorption in that transition from 2020 to 2021, and just how we bucked a lot of the seasonal trends and your typical trends that you see in terms of apartment demand, you know, obviously most of the time during those summer leasing months, and how we bucked that trend in 2021, and then how that led then to the downswing, where we had the first 3 straight quarters of negative absorption for the first time ever. And there's that little note up top dating back. We have history dating back to 1993 in terms of apartment rent. So first time ever, we've had 3 straight quarters of negative absorption, which is obviously what led to the overall annual number being negative as well, and being that first time since the Great Recession. And I love this slide. We've been using this slide in kind of our national decks and presentations for a couple quarters now. And this teal color is going to be your 20-year average. So you can see from 2000 to 2019. And this is that seasonality I talked about. You can see in the first quarter, during those 20 years, we typically get a little bump in absorption. And then you can see you get your bulk in the second and third quarters. And then it's not uncommon for the fourth quarter to go negative. You know, you're in your cold weather months. A lot of the times, even in states like Texas and Florida, you get less of your leases renewing during that winter time period. You've got the holidays. So not, you know, not beyond typical to see that go a little bit negative. Then when we turn to the pink bars, now you see how different 2021 was in terms of apartment demand. And you can see we were, you know, well above in the first quarter, well above second, third, and even had very high positive absorption into the fourth quarter. And then you can see how then we went the opposite and again, buck those seasonal trends when we take a look at 2022. You can see in the first quarter still held a little bit of that momentum coming out of the fourth quarter of 2021. And it wasn't until the second quarter and then, you know, into the third and fourth quarter in which we saw absorption go negative. And we'll get into kind of the reasons why, you know, we think that starting in that third quarter that things started to go negative. And you can't talk about kind of absorption and demand, which is occupancy, without talking about resident retention. And for those of you that might have attended a couple of years ago, I don't know if Carl highlighted the retention, or there's a couple other metrics that I'll get to when we get into the Florida markets. But through RealPage, we have property management software. And so through our revenue management software and our back-end property management software, we're able to gather all of the transactions that are happening as people are leasing apartments in all the major markets that we cover. And so the resident retention is going to be the percent of leases that are expiring that are renewed. And that's going to be one of those transactional metrics. And so when you look at how occupancy is comprised. You're going to have your resident retention, and then you're going to have that kind of front door demand occupancy that's brought in by the new leases. And so when we look at the occupancy level, and we'll get into a little bit here in a second, where that negative demand caused that occupancy contraction year over year from the latter part of 2021, but we're still in really good shape when it comes to resident retention. You can see that trailing 12 average is still well above typical norms, and you will see some moderation here, but that's not anything that's out of the ordinary. You're going to get some moderation in the wintertime. And again, just like you'll see when we get into the Florida market, is what goes up must come back down. And so we had record high retention rates from 21 that carried into 22, and now we're just seeing some of that moderation. And another good sign when we look at, now we primarily focus on, or our research group primarily focuses on market rate apartments. We do have a student housing section or sector, but we primarily look at market rate apartments. Now through RealPage, we do have data on the rent restricted affordable housing. And so what you're looking at here are rent collection trends. So again, with that, all that transactional data, we're able to gather, are people paying their rent? And you can see even throughout, saw a blip kind of in those early COVID days from these market rate apartments, but been on a steady pace and actually up year over year since August. And so you're not seeing affordability issues. You're still getting residents paying their rent, despite some of the challenges that we hear, out in the economy. And here's another example of why the data suggests, and that we suggest, that we're not seeing, at least as of yet, a flight to affordability. And this is going to be your year-over-year change in your occupancy rate, and you're going to see it's by class. And if we were actually seeing a flight to affordability, you would see Class A and Class B moderate at a much quicker pace than Class C, if even Class C moderated at all, if it was truly picking up some of the renters from the higher price Class A and Class B. And you can see from these trends that they're all moderating at a very similar pace, and not surprising that Class C is still leading and so above as of December of this year. And the more interesting thing is when you look at that kind of orange line of the Class B, is that Class B has actually moderated below Class A. Could be going to other Class B assets. Could also be that maybe there were some discounts from Class A and they're kind of pulling up Class B renters. But either way, one of the key takeaways is here, no flight to affordability that we're seeing, and that your occupancy rates by class are moderating at a very similar pace. So here's that consumer sentiment we talked about, and we can see it's not a direct, one-to-one correlation with annual absorption, but you can really just see how you saw the peak of that demand come up in that middle to end of 2021. Consumer sentiment was fairly high, but not as high as kind of before COVID. And then as that demand dropped, consumer sentiment just dropped. And Carl actually had a slide. We were doing a REIT webcast, I believe it was last quarter. And he had a slide, and it was quotes from all the different major news outlets about kind of the doom and gloom and the recession and everything. And one of the key things not only was consumer sentiment is highly correlated to the headlines of what we're seeing in the news, but the interesting thing about it is every single quote that he had on that slide was from like the last 5 business days at that point. So it wasn't even as if he was taking quotes or that doom and gloom over a longer period of time. And so we can really see how some of the narrative that we see can affect consumer sentiment, and what that's done to kind of freeze household formation in 2022, which led to the negative absorption. And kind of, flying in the face of almost that consumer sentiment is the fact that the pace of job growth is higher than any pre-COVID period since 1995, and we've fully recovered all jobs from the 2020 layoffs. And so this is what makes that kind of recession, or the R word discussion, as some people say, so nuanced, is that we're in a period of tremendous job growth and still very low unemployment, and yet we saw the lowest apartment demand on record for a calendar year, again dating back to the Great Recession. So here's kind of a summary slide, and I do want to touch on all these because it does help to kind of bring in and talk about kind of the full picture. So, we've got really robust job growth, second highest total since 1939. You've got, even though the narratives have been all about the multifamily rents, we can see that single family home prices are actually up more year over year than multifamily rents are. One ability that we have, and we actually came out with a study middle of last year, was taking a look at median rent to income ratios. And you can see not only were the actual payments of rent still very strong, but when we look at the median rent to income, it's still very affordable. Your typical and most professionally managed apartments, you're going to get screened on about a 1/3 affordability. I think New York might be 1/5, and I think some California markets might be higher too. But typically, it's the same thing that banks or credit unions, when you're looking for a house, it's at 1/3. And so when you look at a median rent to income of 23%, that's very, very healthy, and that's led to, again, not only the health of the overall apartment market, but then the viability of the economic recovery of a lot of these major markets, as that's a lot of additional income despite those rent increases that can still be spent to kind of further recover in the economy. We can see the average renter income up 13% year over year to $95,000. I do want to make a caveat. We do track your professionally managed market rate apartments. So by no means is that figure kind of meant as a broad brush. But the income that we capture on our lease applications is going to be a very good proxy for the type of renter that we are currently tracking, as those renters are specifically applying for, screening for, and getting approved for the apartments running on our software. And then again, we talked about the rent collections. So when you look at it, the economic drivers favored a stronger 2022, especially when you look at that job growth and the affordability and the rent collections and the income. But the combination of that abnormal extra demand and some could say pulled forward demand that we saw in 2021, combining with that waning consumer sentiment, resulted in that sluggish absorption. And when you think about it, I believe the Fed started doing the rate increases around March or April. I think they started with 1/4 point increases, and it wasn't until like the mid-year when they started doing the 3/4 point increases. And that's right about the time that you're going to get your college graduates in that May timeframe. And the data shows, again, when you look at this U.S. job growth, that those college graduates got jobs, and for what we're seeing in terms of the affordability, got good paying jobs. They just foregone the decision to kind of create household formation and go rent apartments. And either stayed home with parents or had other options, and so that's part of where we're seeing that kind of sluggish demand in 2022. So we talked about rents and occupancy are quickly moderating, and the key fundamental question is right there: is the ongoing moderation a return of normal? And I know throughout COVID we all hate that term normal now, I'm sure. Or are the underlying fundamentals shifting beyond that normalization, and are we in kind of a panic kind of mode in a sense? And when we look at the occupancy rate here, and you can see that that's quite a lot of contraction since the last or the end part of December of 2021. But when you take a look at kind of where we started, there was definitely a lot of room for moderation. We had record occupancy in the latter stages of 2021 to almost 98%. We had some of the markets in Florida that were upwards of 98.5%, 99%. At that point, you're essentially full. So we do have some cushion. And so this, large moderation, again, is more of just a lack of household formation and kind of bringing back down to kind of your more normal levels. And you can see this is a kind of a color-coded map here. We've got the legend over here. The darker the circles are going to be a larger occupancy change from December of 2021 to December of 2022. And you can see that all these occupancy changes are negative. And when you look at it on a color-coded map like this, you can really start to see some patterns emerging. When you take a look at, I don't know if you guys can see my mouse here, but this kind of chunk right here, including Florida, That's going to be your quintessential Sun Belt, and then kind of coming through here with Vegas and Phoenix. And some of the California markets did a little bit better, but that Sun Belt was one of the quickest areas to kind of receive the demand and kind of come up. And it was also one of the quicker areas to start to moderate from an occupancy perspective. And so you can see that our cluster here in Central Florida did backtrack, but again, it's nothing that we weren't expecting, even when we were talking in 2021, when again, we said everything that goes up must come back down. So now when we look at rents, this slide can be a little colored, so I'm going to go through all the different ones individually. So when I talked about the lease transaction metrics, so the actual transactions that we're able to gather data on through our software, that's going to be this new lease rent or new lease trade out. And what that is if I'm a resident in a unit and I leave that unit, what does the new resident pay above or possibly below what I paid? And then same thing with renewal rent trade out. If I'm a resident in a unit and I renew on that unit, how much am I paying above or sometimes below what my previous rent was? And then in-place rent is going to represent your actual rent roll. So what is the rent roll looking like? And then your orange is going to be your traditional surveyed asking rent. So we still have those metrics as well, where we have a research team that goes out and calls all of the properties that we track in our survey and get and we get the rent, the advertised rent for the apartments that are, for lease. And we can see in all of them, let's specifically talk about the new lease trade out and the asking rent, because those are kind of more comparable, that those are, again, to what we saw with occupancy of all asset classes following that same pattern. You can see that the new lease trade out is cooling and moderating at a very quick pace. Your asking rent is doing that same thing, and now they're hovering around that 6% range and still above kind of that long-term norm, but did moderate quite a bit from the recent highs. And we can see that in-place rent, due to even then renewal starting to moderate a little bit, is starting to kind of slowly moderate as well. So there's a little bit less renewal runway as we head into 2023 than we might have originally thought. But again, still well above historical norms, just a shy below kind of that double-digit range. And we talked about the change or the income or the resident income that we can track. I think we can see, again, not a one-to-one kind of correlation, but we can see that household incomes do have a correlation to the change in new lease effective asking rents, and we can see that moderation as well. And so despite the fact, again, that both are moderating, they're still at very, very healthy levels. So I went ahead, this is just going to be our top 50 markets, so only Orlando and Tampa fall into that. So the other markets that we'll cover later on don't fall within the top one or the top 50 set. So what this is showing is, these are all in alphabetical order in each column, and this is going to be the cumulative rent cuts for the fourth quarter. So the 3 months of the fourth quarter, the cumulative rent cuts and what buckets each of these different markets fall into. And again, what I talked about on that map is that the Sun Belt was, at the forefront of that demand run up in 2021, and it was also now receiving the brunt end of that moderation curve. And so not a surprise that you're seeing your Vegases, your Phoenix, obviously some of these markets here that have seen cuts greater than 2.5% are also a lot of the markets that are receiving higher end supply. And then we can see Orlando and Tampa, Jacksonville, and some of your other Florida markets and the cuts of up to 2%. And conversely, I know we're centered on Florida, but your kind of slow and steady, true Midwest kind of markets are concentrated here with no cuts. Miami actually had rent increases of 0.5%, and then Newark, which is neighboring New York, is still benefiting from the demand that we've seen there. And so we see that there, and then you still see St. Louis, and then West Palm Beach made it, so no cuts in West Palm Beach. So we've talked about demand, we've talked about the occupancy and rent fundamentals. And now as we kind of head more towards the forecast portion or kind of looking ahead, and then when we dive into the Florida market, now we're going to look at construction, because construction is really going to kind of dictate the course of the next couple of years. And this bottom sentence here is crucial. If you look at a lot of stories or headlines, whether it's on LinkedIn or through the papers, is that we have a shortfall of housing. And so the long-term implications of this record development that I'm going to talk about are very good and will go to kind of further lessen the amount of units that we need that we need from a demand perspective all the way out to 2035. But the near-term impacts are going to be felt within that higher priced kind of luxury Class A product. And you can just see the steady stream, again, kind of a little blip here, during the early parts of COVID. I think that was more just some offices were closed, permit offices and things like that. So you almost had kind of like a forced slowdown because otherwise we're even on a faster pace that if we were to remove that and just draw that straight line, we're at almost 1 million units currently under construction. And again, market rate units, but 1 million units under construction as of the fourth quarter. So an absolute huge number of units under construction. We can see that it's starting to kind of taper off slightly, but still obviously in record territory. And so when we look at, and this is just showing the first kind of 3 years of deliveries from a forecast perspective, is 2023 is set to be an absolute record year when it comes to completion. So of the almost 1 million units that are currently under construction, you can see that this current forecast has roughly about 600,000, so about 60% of those units delivering in 2023. Now, we forecast supply just kind of on a net basis, so we don't bake in any delays. I've toyed around with some numbers. Delays used to run around 10, 12%. They're a little bit elevated now at around 16, 17, 18%. So there's a high likelihood that some of these will then get pushed into 2024. But you can see that even if that happens, 2023 and 2024 are set to be record years for supply in the U.S. So this is showing different kind of, we've got the 5K buckets kind of on the end, and then we've got 10K buckets. Again, the top 50 markets that we look at, so the top 50 largest markets, and where these are coming. So again, only Orlando and Tampa. Orlando, that's an elevated number. I'll get more into kind of the supply aspect of it when we get into the actual market breakdowns. And then Tampa, it's about 15,000 units under construction, and that's kind of on pace with what we've seen, so not too crazy elevated. And you can see, so now this is what we're looking at, the percent of inventory under construction. So we'll take the number of units under construction as a percent of the existing inventory. And so the way to read it is this, we'll take this bottom blue one, this is probably easier to see, is say the number's 10. For every 100 units of existing inventory, there's currently 10 under construction. So I think I did a blog maybe last year around this time, and I believe Nashville is still number one. Nashville right now has 15 units under construction for every 100 existing. And you can see that there's a lot of heavy construction, even from a percentage basis in your Florida markets. And so again, certainly something to keep in mind, and we'll get more into that when we get into the individual markets. And this is the other kind of portion of that from a kind of supply perspective is your lease up velocity. So all these apartments that are under construction eventually end up in that lease up phase, and obviously want to get them leased up fairly quickly. And we've seen that the number of units leased, which is the line, versus the number of units in lease up, actually peaked around that kind of early 2021. Then the pace of the actual lease up units kind of fell off, kind of came back up again. You do see some, as you can see when we go in the past, you do see some seasonality in these numbers. And now we are moderating at a very low pace. And we're moderating at a much lower pace than what's typically seen when we're then expecting more and more supply. And so, definitely, as it says, there are proxies for near-term Class A expectations. We'll talk about rent growth now. And actually, I want to come back here. Market level variation shows a divergence of performance expectations across markets throughout 2023. And you'll actually see that when we get into the Florida markets. The overall trajectories are similar, but I think once you kind of bifurcate, say in Orlando, and I believe Orlando maybe has like 10 or 12 submarkets, your overall Orlando performance could be one thing, and then each individual submarket could be on a whole nother level, again, depending where the specific supply levels are in those particular submarkets. And you can see from a forecast perspective, I don't know if it's hard to see kind of that bluish color. You can kind of see it right here underneath the lettering. The forecast was slightly downgraded from the previous forecast that we had done that shows there as of October 2022, a little bit based on kind of how the current performance of the fourth quarter came in. And then some of it was also on the economic variables that factor into the forecast. But just a slight downgrade, and the bulk of that moderation is done 2023. So you can kind of see in this little area here, still looks very good before things start to kind of more normalize or stabilize it once we get into the kind of the latter part of 2023 and into 2024. And you'll know, and this kind of moderation curve is something that you'll see once we get into the Florida markets as well. All right, so that was the national overview. Any questions on anything that I went over nationally, whether it's supply, demand, anything about the forecast before we dive into our Florida specific markets?
Dan, a quick question. How does population growth kind of factor into your analysis?
That's a really good question. So when we do our forecasting, we have an AI tool that we use to do our forecasting, and we actually get economic variables from another provider. And one of the sets of variables is population growth. And then we can actually break that down into the different age cohorts as well. And then you've still got your job growth, we've got retail sales, you've got net migration, all the different kind of factors that would weigh into actual multifamily apartment demand factor into our forecast, as well as obviously our own rent, occupancy, and supply data as well.
Fantastic. And I guess before I turn it over to others, on the doom and gloom part of this, right? Essentially that consumer sentiment part. How fickle is that? I mean, from time to time, from your perspective, I still remember, COVID, everybody was kind of, put their head underground and nobody wanted to do anything. We were still investing. So I'm just curious what that kind of looks like to you, from your perspective right now.
Yeah, absolutely. So the consumer sentiment piece is really, we've used that as a proxy for household formation and for, kind of overall decision making, whether it be, purchasing a home, purchasing a car, those larger kind of purchases. And so we saw that, kind of manifest itself in, lack of apartment demand. So the consumer sentiment led to kind of a freezing effect in that decision-making process. And we certainly saw that again for those college graduates from May of 2022 that never materialized into that summer kind of demand. So the consumer sentiment piece is more from a demand perspective and less necessarily from kind of an investment perspective. We're very bullish on the overall apartment market. Even before COVID, multifamily was doing very well, was a very good hedge against inflation. Multifamily performed excellent throughout COVID. One of the reasons why we started tracking the payments statistics, or were able to extract that, was due to kind of the early stages of COVID, that 2020 timeframe, to really see like, are payments going to fall off a cliff? Is affordability going to fall off a cliff? But from an investment perspective, I think the moderation of occupancy and rent growth, and then obviously depending where you're at and the kind of local fundamentals from a supply perspective, is really what's your overall strategy, what's your renter pool, and are you kind of that Class C workforce housing? Are you in value add in that Class B space? In which, usually that's kind of the most affordable, or you ground up development, so you operate in that Class A, which, as we said, with the supply is going to be challenged. So hopefully that helps to kind of answer the question from that perspective.
Yeah, absolutely. Thank you. Tim, I see you got your hand raised.
All
man.
right. Well, let's head into.
Hey,
Oh.
hey, Dan. Sorry, Tim Little here. So I just had a quick question regarding the different classes. You talked about all the construction that's being done right now. Is it safe to assume that the vast majority of that is going to be Class A?
That is correct. Yep. There was, I don't remember if it was, which REIT it was, Avalon Bay or another REIT was trying to create a separate, part of their development strategy that, I mean, I guess it'd still be Class A, but they were trying to kind of hit a lower price point. And I've heard of other clients trying to do that as well, to kind of balance some of that, value add that's out in the market. But your everyday, kind of Class A apartment is going to be, that new construction, because with land costs, labor costs, material costs, I mean, that just ends up being what it is. And a lot of times they're highly amenitized buildings, brand new. You're getting all the latest and greatest appliances, pools, gyms, all that type of stuff.
Yeah, and I think it's easy for us who invest more in the B and C class to kind of blow that off and say, oh, that's a non-issue. But I'm trying to think through the worst case scenario, and I guess the worst case scenario from my perspective is if you get this flood of Class A properties coming onto the market, then they're going to have to compete with each other in terms of price, drives the rent rates down for them, and then all of a sudden we're being cannibalized at the B class by these A class that are competing with each other. Is that something that you see as a possibility or a likelihood?
It definitely is. It's not something that I would paint with a broad brush, because I really think it's really going to be determined by the local fundamentals, because it's really going to be, how many properties are there, and then how, concessions on lease ups are, typically standard. But how, much further into that concession bag do you have to dig? Because, once you get into the 2-month concessions, or even there were certain areas of like San Francisco that were in the 3-month concessions, now you're digging so far into that bag that now you could possibly then, on a concession basis, bring up a Class B renter up to a Class A. Now, a caveat with that, from a concession basis, is that typically a concession is let me rephrase that, when applicants are getting approved, at least in, again, what we track, that kind of professionally managed market rate, is you're still getting approved off the base rate. So your concession could be 5-6 months, but if the base rate is $2,000 a month, your salary and your approval is based off of that. And so once that concession burns up, they can still afford it. So, now what happens with behavior in terms of, will people in that Class B stock, if the concession is large enough, then go up to Class A? That's something that can certainly happen. But I think the vast majority would have to get into that 2 to 3 month range in most instances, that I just don't see the pro forma doing that. And so then, Class B then remains a little bit more insulated.
Okay, no, I appreciate that. That makes sense. So, they'll be competing based on the concessions versus actually lowering the rents and allowing those people to move up. Okay, thank you.
Mm-hmm.
Fessy, you got a question?
Yes, very interesting data. So thank you, Daniel, for sharing. I know there's a lot of press out there talking about housing shortage and how we need 600,000 multifamily units a year. So it seems like the demand is potentially there, although as per the data you just shared, it has slowed down considerably in the last few months. How much of that slowdown in demand do you think is related to affordability? So, and that's kind of what we talked about on the first couple of slides, is we're not really seeing that affordability factor in as the reason for some of the sliding demand. It's mainly just that household formation. And a lot of it also is just the timing and how COVID unfolded and then how 2021 unfolded. If you think about it, a lot of the lockdowns, occurred, I believe it was around April timeframe. So then you had May of 2020 graduates that most likely did not enter that renter pool. And then maybe even during some of the COVID, there was some doubling up, roommate situations, maybe relationships, you had some coupling. And so what you saw in 2021, and especially as it relates to Florida, is not only did you have high in-migration into a lot of your, freer states, and obviously talking about Florida and Texas, no state income tax. You had this work from home phenomenon. That's where a lot of these markets, call them Zoom towns, call them lifestyle markets, became popular. And so you just had this flood of demand caused by the household formation. You're bringing all these college graduates into the market, the decoupling, job growth has been phenomenal. Wage growth has been phenomenal in keeping up with those top line rent growth numbers. And so that's what led to that demand in 2021. And when we talk about how 2021 kind of pulled forward demand, meaning that demand that in a normal case would have happened in 2022 was pulled forward into 2021. And that's kind of then what left 2022 a little bit more bare from a demand perspective. But it actually it moderated a lot more quickly than we had thought because of that consumer sentiment and not getting kind of back to the typical seasonal patterns of college graduates entering that summer demand pool and then bumping up those numbers. You get a little drop off in the winter, a little bump in the first quarter, and then kind of riding that seasonal wave.
Thank you.
And that's a big thing. I don't know if I mentioned it, but when we look forward to 2023, the first quarter in most markets, there are a couple markets in which the first quarter ends up being a pretty decent quarter for demand. But in most markets, the first quarter is really not going to tell us a whole lot of if that demand is coming back, if we're getting back to quote unquote normal. It's that second quarter where you're going to get your college graduates, you're in your kind of prime spring and into summer leasing season. That's really going to kind of tell us kind of where we're at from a demand perspective. Any more questions? Israel, very good. Right. Well, let's jump into, so on the major Florida metros, it's going to be Orlando and Tampa. And again, major is going to be our top 50 markets. So what I did here is, and we've got that new lease trade out and renewal lease trade out, and all these slides will be consistent upon markets. And so you've got the new leases in this kind of greenish blue color, and then kind of a darker blue color, you've got renewal leases. And you've got a lot of data over here. I'll touch on some data points. And then I think I sent the slide deck to Israel. I don't know if he typically sends it out, but we can send it out if need be, if you want to dive in afterwards as well. But when we look at Orlando, it talked about kind of the moderation curve, and that it'll be a theme as we kind of run through all these, and you're really seeing it. And one thing when you look at the Florida markets is because of the amount of in-migration that came into Florida, some of these top line rent growth figures are absolutely crazy. I mean, you're talking almost 30%, new lease trade out and kind of those peaks. And then it has moderated down to, sub 10%. And what you're seeing a lot, I can't remember if all these markets are, but you're now seeing, here we go, this inversion curve right here. So now you're seeing your new leases actually fall below your renewal leases, despite the fact that both are kind of moderating. And so the interesting thing is, as we head more into 2023, is at what point does then that kind of moderate back to normal, where new lease is above renewal lease trade out. But talked about kind of the annual demand figures, actually was positive, just slightly positive in Orlando. Did backtrack the occupancy almost 3 percentage points, but still fairly healthy at 95%. And what's interesting as we go through these markets, a lot of the Florida markets ended up with that demand boom in 2021, got to very, very high occupancy. And so you can see still a very healthy 95%, even with an almost 3%, contraction from the prior year. We can see the resident retention still very high at 57%. So you're still propping up that occupancy with that backdoor demand as well. And then when you look at that units under construction, that's an interesting one. So 21,000, it is elevated to kind of recent historical norms. And the 1 year, I'll go to the next slide here. Actually, maybe I have it here. Of those 21,000 units that are under construction, about a little over 13,000 are set to deliver in calendar year 2023. And that actually represents a doubling of deliveries of what we saw in 2022. So deliveries will certainly be, something to look out for in Orlando. As I talked about Class A, is going to, face kind of the brunt of that struggle when it comes to the lease up velocity and then also concessions as well. And when you look at a market like Orlando, if we did get into some recessionary environment, depending what happens in these first couple months, Orlando could, suffer a little bit because of the tourism industry and what that might mean to consumer spending. So that's always a caveat out there, but definitely got to keep an eye on those deliveries, depending kind of where your deals are located and what else is around you. And when we look at the actual forecast, and I will note that when we forecast the effective rent change, that again is that surveyed rent. So the rent that our survey team is calling properties, that's going to be what we forecast. And then obviously the occupancy, which is that same data point that our research team gathers. And you can really start to see how steep that moderation curve was throughout 2022, caught a little blip back in the fourth quarter. And then the forecast in kind of this early part is downgraded slightly, again, just due to that supply. You can even see that reflected here in the occupancy where it somewhat stabilizes and then kind of comes back down to below normal levels of around 94%. And it's, despite that, it should still remain above US levels, but certainly moderating from the highs that we've seen over the course of the past year and a half. And very similar when you look at Tampa, very big moderation. Tampa got just above 20% on that new lease trade out. Renewals got pretty high at about 15%, both moderating. Very sharp curve on the new leases. Renewals are moderating as well. And we can even start to see a little kind of pick back up of new leases. And so when you get those kind of supply demand fundamentals, you can get those shifts. And so I wouldn't be surprised to see in the early parts of 2023 that we get the inversion back to what you would typically see where new leases outpace renewal leases. We can see, again, kind of that negative annual demand number, just shy of 95% occupancy, did backtrack 3.3%, which is a big contraction from an occupancy perspective. But again, based on the amount of in-migration and household formation and all the other demand drivers that a lot of the Florida market saw, it's not surprising then that when you kind of put a freeze on that household formation, that demand starts to diminish and you start to lose some of the occupancy rate. When you look at the units under construction, almost 15,000 units, about half of those are going to deliver in calendar year 2023, similar pace to 2022. So supply is not as much of kind of a headwind as it is in some other areas in which it's elevated to historical norms. But very similar, trajectory. I mean, that's going to be a theme is like I said earlier on, what goes up must come down. We knew this from the beginning. I think we thought that maybe the moderation curve would happen a little slower in a lot of the major markets. But again, due to that consumer sentiment and some of the interest rate hikes by the Fed and what that did to the single family market, we saw it kind of moderate a little bit quicker. But unlike Orlando, what you see here is you're still in better shape in 2023 relative to, again, what we saw in Orlando. And we're actually seeing kind of a stabilizing or a normalizing effect within the occupancy rate. So, consistent supply levels, that forecast model is going to pick up, that the market can handle it from a demand perspective. And we're going to see that stabilizing, around that 95.5%, 96%. So very good outlook when it comes to Tampa, and actually has one of the best near-term forecasts when we kind of just re-upped our forecast. Now we'll get into the secondary Florida metro. So secondary is going to be what rounds out our top 150 markets. So then these markets will fall in that 100 bucket. And so now we've got Palm Bay and then Sarasota. It's technically Northport, Sarasota, but we look at it from Sarasota.
Dan, can I jump in before you get into the secondary on a comparison between Tampa and Orlando?
Yeah, absolutely.
I just, from an observation standpoint, I remember that Tampa seemed to have peaked a little bit sooner, coming out of COVID than Orlando did. Do you believe, or could that be part of the reason why it's kind of moderating a little bit faster on the back end? In other words, it's kind of crawling out and stabilizing a little bit sooner because it started sooner and it's downturn?
That could be a part of it. I mean, that's certainly what we saw in Phoenix. Phoenix actually started moderating. I went to our real world user conference in July, and we had so many questions on Phoenix because it was fitting that exact mold. And Phoenix was one of the early adopters where it started seeing some of that demand materialize in the latter part of Q1 21 and even into Q2 21, and then was one of the first ones to moderate because of that supply as well. I just think Tampa is one of those that you can see too, where, and I kind of wrote some notes here on the left side, that 1814 effective asking rent number, that's as of December of 2022. The rent in February of 2020 was just a shade under 1,300. So that's a big increase from a rent perspective, and that could be where then you're seeing some of that moderation because some of that occupancy backtracking could be people, leaving the market and kind of going somewhere else, to a different market for affordability, even though from a kind of broad stroke, we're not seeing that flight to affordability, but you could see these individual pockets that then affect neighboring markets having different trajectories kind of on this moderation curve. Because it was the same thing. Not every market kind of went up at the same pace, and not every market's going to kind of come down at that same pace either, or land kind of in that same realm.
Got it. Thank you.
All right, let's jump back into, so here's Sarasota. And again, going to be a broken record, but very similar on the moderation curves when we look at the new leases and renewal leases. Again, inverted, will we see them kind of reverse that inversion? But crazy to think that even a market like Sarasota got over 20% new lease trade out even in parts of late 21 and into 22 before, again, when we lost some of the demand and started to drop some of the new lease pricing as the renewal lease pricing was kind of rising. Again, look at those demand figures. Ended up a little bit better from an occupancy rate, so still again very healthy, just under 96%. Still getting propped up from that resident retention. To give you an example, usually I'd have to look at the long-term norm, but at least from the kind of a U.S. perspective, it's around 50, 51%. And I think in the U.S., we're still hovering around that 55, 56%. So that retention rate is still really high and kind of propping up that occupancy. And why that is until you had this reversion, or this inversion, I should say right here, is that in a lot of cases, and we can even kind of look at these different peaks, even at a 15% renewal, it's still more economically feasible for me to stay in that unit than it is to go pay almost 19% or 20%, whatever this is, to go to a new unit and then pay moving expenses and everything else. And so that's where you're seeing kind of that resident retention. And even that is starting to moderate as a function of now renewals are starting to moderate and now new leases are actually below it. And so now if someone does want to move, they can move. And very similar when we look at from a construction perspective, a lot of construction was ramped up over the last year and a half or so. So when you look at that almost 7,000 units under construction, the deliveries that are set to come, and we revise this every quarter, but as of now, they're set to come in calendar year 2023, is going to be almost 5,000 units. So you're talking the vast majority of what's under construction, should, barring any, delays, should deliver in 2023. And that's about 5 times the amount of supply that we saw in 2022. And so we're really going to need that demand to kind of bounce back to typical levels to really, get on track with that supply. And again, to what we talked about earlier, the vast majority of this supply, if not all of it, is going to be at that Class A level. And even, when you're talking about brand new construction, depending on how amenitized it is, it's really kind of even at that Class A plus perspective. So again, very, similar moderation curve. And despite the construction, we're still having that occupancy. It's not functioning as poorly as we saw in Orlando. So you're still getting some of that stabilization. You do see, since these are quarterly figures, that seasonality where you're going to get up in the summer months, down in the winter months, and kind of so forth. So despite the supply that's set to come in 2023, we still have occupancy, bouncing back up to about that 96% range. And just look at, it was almost at 99% at the early part of 2022, which is just crazy to think about for a market like Sarasota. Again, very similar things when we look at Palm Bay. Palm Bay actually had, positive annual demand, and you can actually see that reflected. And I should say, when we talk about demand and absorption are synonymous. And really, the way that we look at demand or absorption, it's going to be the change in occupied units from one period to the next. So it is a calculated value. When you look at the demand drivers, that's then when you get into population growth in different age cohorts, job growth, retail sales, net migration, all those kind of economic factors that can factor into what would account for the economic demand. So you can see, again, that same inversion, and one interesting takeaway, and actually I was talking with another coworker when I got into Dallas a couple of days ago, is taking a look at these effective asking rents for some of these smaller Florida markets. I think I wrote on this one, it was just above 1,100 in February of 2020, and now it's above 1,600. And so almost a $500 increase in the span of a year and a half. And so a couple of points on that is not only that's the effect of these top line, new lease rent changes and these percentages that have been touted kind of in the media that we've talked about over the course of the last year and a half. But what that does is now your base rent for some of these small markets is elevated to what it has been historically. But that's also true when we think about even on this moderation curve, is that now when you're looking at, what is this, about 5.5-ish, maybe 6% rent growth here in the early part of 2023, that now 5.5 or 6% is off of the 1,600 figure, not the 1,100 figure that it was before. And we're just moderating back to kind of normal levels of, rent growth of 2, 3, 4, 5%, depending kind of what market it was, how much job growth you had, and how much supply you had. So we're just getting back to kind of the basics of those supply and demand fundamentals within a lot of these markets. And certainly a lot of these Florida markets that were huge benefactors of all of the demand drivers that we saw in 2021. And then a lot of those kind of froze up, especially your household formation. Now we're going to get into the tertiary Florida metros. I think these are similar to what we talked about last year. So you've got Deltona, Gainesville, Lakeland, and then Ocala again is small enough from a multifamily perspective. I think we only sample in that maybe 3,000 or 4,000 units. That I had to do a little bit different on that slide. It still has a similar look and feel, but I'll point some things out on that particular slide as well. So Deltona, Daytona Beach, again, very similar. You see the inversion on the new leases. I'm going to become a broken record at this point. But what's also very interesting is that a lot of these markets operate very, similarly, where a lot of the peaks on those new leases were around that 20% range. I think we saw it higher in some of your major markets like Orlando and Tampa, but a lot of them peaked out at 20, and a lot of them, that renewal peaked out at about 15 before it started to moderate. So a lot of similarities within these metros, even though they're kind of spread out, amongst the state. And you can see, again, sluggish annual demand figure, but it, still positive in that respect. Still a very healthy occupancy at 95.3%. Still propping up that occupancy with good resident retention. And from a construction perspective, it is slightly elevated to what's typically seen. But it's not a crazy amount of construction. The bigger thing when looking at that particular number is that almost all of those units as of right now are forecasted to deliver into that market in 2023. And so that's going to be a huge number to get in that period of, recovery period or whatever term you want to use from that perspective. And so, a lot of, but again, depending where those are at and how they necessarily compete with what you're looking at will then dictate what your individual strategy is. And so if you're in Class C workforce housing, Class B, and you're not necessarily competing with these, then maybe they're not as big of a concern unless they start to kind of push into the concession bag a little bit. And again, very similar from a forecast perspective, despite the supply, you still see that occupancy recovering and getting back again to more normal levels. You can start to kind of see patterns as well, where I know a lot of these, look very similar, is that the occupancy, even though it's stabilizing and it's getting more towards historical, norms, it's still not kind of up to where it was kind of pre-COVID. So you are getting a little bit from a supply, but we're not seeing it, sub 95% and being affected in that perspective. You're still kind of very healthy in, very good outlooks. It's just some care needs to be taken, again, with that Class A outlook. And Gainesville, very similar, again, peaked out at about 20%, about 15% for renewal, inverted. And we're starting to see that this new lease trade out start to come up. And that was bound to happen because this inversion is not typical. And what's interesting is when I started looking into Gainesville, obviously, tied to the University of Florida, but not a very big, at least because this is going to be strictly market rate. This is not going to include the separate purpose-built student housing that we would track separately, but just not a lot of recent construction when it comes to that market rate multifamily. So just a shade under 800 units under construction. About half of those are going to deliver next year. That's around the same pace that we saw, this past year. So, you're very consistent with that, very moderate supply level. Still getting good trade out and renewal or new lease and renewal trade out numbers. Big resident retention number at 62%, which is helping to prop that occupancy up. You can see this one's even stronger than a lot of the other markets that we've seen. Now you're pushing close to 96% while even backtracking 2.5 year over year. Again, shows you how high these occupancy numbers got with this slew of demand that we saw in 2021. And very similar from a moderation perspective. I think it's probably hard to see, and hopefully if we send out the deck, you guys can dig in a bit further. I forget which market it was that we started with, had kind of more of that sharper downturn. But a lot of these moderation curves are going to be similar. There is some nuance kind of in this 2023 timeframe. They're all not, they're around that 5-6%. Obviously it's a regression model, so you're going to want to get back to that level. But very similar trajectories, and really one of the main things that kind of factors into a lot of these markets is going to be that localized supply perspective. And again, kind of a broken record here, the 20%, 15% inversion. One thing I haven't really been pointing out, we talked about the resident income, but some of these numbers are just jaw-dropping that in a lot of these kind of smaller markets, and I think it lends itself, I'd have to look back at kind of what some of the numbers were previously, previous to some of the in-migration, but almost $100,000 average resident income. And that just shows you, again, that affordability, that even when you're talking about a rent at $1,520, that used to be $1,100, so $400 more. If your average new lease signee has a resident income of $95,000, that is a very, very healthy rent to income ratio, which bodes well going forward. Lakeland is one. I know we're kind of a broken record now at this point from a supply perspective, but Lakeland is one that we just did like a quick insights chart that's on our website with the small markets that have a very high percentage of units of the existing inventory under construction. And Lakeland was on that, just a shade under 4,100 units under construction, and very similar where you're getting more than half the units are set to deliver over the course of 2023. And so I think what we're seeing is that a lot of this permitting activity started at probably the beginning part or maybe the latter part of 2020 into 2021, broke ground, and then now into that late 2022 into 2023 timeframe. And you even saw that even from a national perspective when you looked at the overall supply forecast and how much larger 2023 was versus what we saw in 2022, is now you're seeing the effects of where all of this supply is coming, and it's in all the markets that saw the most amount of demand in 2021 as the local developers saw that and then started building. So definitely need to keep an eye on Lakeland from a supply perspective, as you know, what's going to be delivered in 2023 is about 3 times or almost 3 times what was in 2022. So that, you know, it's bound to put some pressure. And this is one, because of the lower number of existing multifamily units, this is one where you do see that supply affect the occupancy forecast a little bit more than I think what we've seen in some of the other markets. And you can even see from a rent growth perspective, it actually, instead of, you know, kind of just moderating a little bit to historical norms, this one actually kind of downgrades a little bit. You get that drop in occupancy as well. You get a little bump in kind of the latter years as some of that supply kind of works its way throughout the market. But you're still having occupancy sub 95%, which is, you know, kind of well below where we were in that 2019 timeframe. So definitely being affected by supply in this particular market. And it is one of kind of the smaller markets that we're looking at. And I think that's why you're seeing that kind of larger effect from the supply that's being delivered. And lastly, we have Ocala. So Ocala, we don't, since it's such a small market, like I said, we don't forecast the market. We also don't have the transaction metrics. So what I did here is I just changed this chart up a little bit to get some of your supply, demand, and rent change. And this is going to be your, you know, surveyed rents. And then kind of this forecast slide is going to be the same slide that we've typically been looking at in terms of setup. It's just not going to have a forecast. So I just chose kind of a 5-year window going back to the first quarter of 2016. And what I really like about this is now you're starting to really see this kind of ramp up in 2021, you know, very similar to what we saw in the other markets from a new lease trade out. And you're seeing that in the effective leases as well. And then this big moderation curve down, you know, pretty good correlation to, you know, the moderation of occupancy coming down as well. You can see that's actually supposed to be the occupancy rate, not the change. So I should have caught that. Oh, there, I just flip-flopped them. So 95.8. So still very strong at 96%. So again, backtrack 2% shows you how strong that the occupancy was. In this particular one, I did want to take a look because when you look at these supply numbers, Ocala has not seen a lot of supply over the course of the last couple of years. And when I was putting this together, that 1,800 units under construction kind of caught my eye. Obviously, when comparing to an Orlando or a Tampa or any kind of big market, that's a small number, but that really caught my eye. And even though we don't forecast supply, we do have we track individual projects and then forecast out when the units of those individual projects will deliver. And so it's kind of a back end way to where I could get to kind of a quasi supply forecast for Ocala. Now, we'll say this is going to be just identified supply of what we're tracking. It's not going to factor in any economic variables because obviously it's not in our economic forecast. But an interesting one here again is, you know, 1,800 units under construction. About 1,500 of those units are set to deliver in 2023. So think about that, a market that hasn't seen any measurable supply for at least, you know, 3, 4, 5 years. And there was some in kind of I think the 2016, 2017 timeframe, but certainly not at the level of 1,500 units. That will certainly put a strain on some of those local Class A operators, you know, in that market. And especially since from an overall market perspective, it's small enough where the market for us is only comprised of zip codes. We don't even have separate sub-markets of this particular market. So depending where that supply is, that will heavily dictate your strategy with the bulk of those units delivering, you know, in this particular market. All right, any questions? I know we had some good ones from a national perspective. We've had some good ones on some of the Florida markets. Anything that I touched on, obviously a lot of very similar, you know, trajectories and moderation curves and very bullish on the outlook for multifamily. It was a really good question earlier about the consumer sentiment. And that consumer sentiment, I want to preface, was not tied to kind of our overall view of the apartment sector and what 2023 has in store. It was strictly from a purchasing and kind of freezing of household formation standpoint, and kind of a causation of why we saw such weak apartment absorption in 2022.
Dan, I guess a comment, just kind of reiterate on something that you mentioned. Just wanted to make sure I caught that correctly. And two, if I did, I think it's important for everyone to hear it again, is that while we are seeing sort of this downturn, and it trended along pretty much all of the different markets, we're not talking about rents dipping below where they kind of been. Essentially, it's just they're not going to continue to grow in the manner that they had. So it's not like rents are dropping below what they were in, say 21. It's just, you don't have that rent growth that you can project out that says you're going to have any more than 2 to 3% a year. Is that accurate?
That's correct. Yeah. Now, one caveat to that, because when we're looking at annual rent growth, so year over year. We did see in a lot of metros, and I don't think I had on these slides, but quarter over quarter, so from the third quarter to the fourth quarter, a lot of major metros and even some of the other Florida metros did realize rent cuts. In that instance, say you had an $1,800 rent in the third quarter, if rents went down, 0.5%, then you'd have, a lower rate in the fourth quarter. But that was, again, a quarter to quarter standpoint. And even that fourth quarter rate would still be above the 2021 level and certainly above the 2020 level. And it was simply just quarter to quarter, operators changing their strategies, looking at kind of the demand perspective, the front door leasing traffic, and having to adjust accordingly. And so you see that even sometimes on a month-to-month basis. And that's where a lot of that seasonality comes in, is you get month-over-month increases in the summer, and then sometimes when demand slows down in the winter, you get those month-over-month decreases in rent.
Fantastic. And then I guess the only other point that you touched on it, but it's not like you have an answer for it at this point. Essentially, when we get into that second quarter, obviously first quarter is kind of baked in that it's going to be lower as people kind of come off the holiday. But that second quarter and even going into that third quarter, you really got to have a good sense and really measure what's happening almost week to week, because essentially if you have significant exposure, meaning people that are coming out of their lease and are able to go into a new lease, do you keep them? And what do you do with that renewal rate to keep them, or do you let them go because you believe that your new rents are going to kind of start trending back up? And so I think that's the question as we're, operators that are here listening, is how do you factor in, right, that exposure that you're going to have, and how do you plan for that tactically?
Absolutely. And I think we used to have, and I just noticed when I went through the slide today, we used to have the CPI, rent of primary residence, I believe. And that's the census one that I believe is like a 6-month survey. So it's typically lagged. And that is the metric that I believe the Fed has been using when creating this plan of raising rates. And the interesting thing about that is every metric that we talked about here that we track is moderating. Obviously, these new lease rents are moderating quicker, but even your in-place and renewals are moderating. If I were to have that CPI metric on here, it'd actually still be going up. And so you talked about uncertainty. That's part of the uncertainty in the early part of that we're in right now, 2023, and even into the second quarter, is if they're still going to continue to raise these rates, it's what is that end goal, and what does that then do to consumer spending and the consumer sentiment, and at what point do they accomplish what they want to accomplish, and then we kind of get a better vision of where we're at. Because the consumer sentiment flies in the face of tremendous wage growth, job growth, and everything else that you would look for from a demand perspective. So that's where I think Carl and I did a webcast today where Seattle is one that typically sees, a good portion of its demand in the first quarter. So for Seattle, we'd pay attention to the first quarter, but for most other major markets, it's not till you get to that like spring leasing season, second quarter, you're going to get your college graduates. We haven't seen any doubling up, but do we start to see some more household formation as things become a little bit clearer from an economic picture? Any other questions? These are all fantastic. All right. Well, thank you so much for bringing me on. I enjoyed talking real estate and really enjoyed all the good questions. Hopefully everyone will get a copy of the deck, and then if there's any follow-up questions, feel free to reach out. Feel free to link with me on LinkedIn, and look forward to seeing you guys again next year.
Thanks a lot, Dan. I really appreciate it. This is it's always very interesting to hear a different perspective, and I appreciate that you kind of segmented away from talking about that sentiment, and that's kind of a self-fulfilling prophecy for renters, right? For people that are the customers. But I think you do also have to kind of look at, and we talked a little bit about the front end, and you certainly mentioned it, that the operators have to look at this a little bit different. And certainly when you're looking at what kind of returns you provide to investors, you got to look longer than the next couple quarters. And you have to, you factor that in. And a lot of us did factor in significant downtrends in rent increases, if you will, over the years. And we knew we had a couple of good years there, but we also knew that it was going to moderate. So we did some of that. So another question is being able to get in there and still doing some acquisitions at this lower basis that we know we're seeing. So I think that's the key, and I appreciate that. I'm going to dig into these slides some more. I'll make sure I send this out with the thank you note on email, and then of course, folks, if they want to look at it some more and kind of hear this again, because I'm sure some of them are still kind of in shock with all the data, right? But they can always look at it on YouTube. But I really do thank you for coming on and giving us this presentation. I do want to let the rest of the folks know here, and also make sure we get this out to on the recording, is that we do have our next event is actually, we normally do these once a month. We're actually going to do one on February 2nd at 7 p.m. I'm actually going to, and this is by popular demand, because I always have, we have some very senior operators, and we also have some folks that are investors that are kind of trying to understand some of this language. So we're going to go ahead and do a syndication 101 on February 2nd at 7 p.m. We'll send that out. But again, Dan, thank you very much for your time. And to everyone out here, I just want to make sure that you understand that these are the times. Take a look at these deals and make sure if you're looking to invest or you're looking to acquire, that you do it carefully, because you always need to buy right. But this is when the sentiment is down and nobody wants to do anything. These are when the opportunities pop up, and you just have to be ready for them. So until next time, make sure you continue to invest where it makes sense, everyone. Thanks, Dan.